Today I would like to discuss Chapter 11, Current Liabilities with you. And in particular, I will speak about Learning Objective 1, how to account for current liabilities and what. So let's take a look at the definition. Current liability is debt that the company is expected to pay within 1 year, right, to match it the current assets, or the operating cycle, whichever is longer. So current liabilities include notes payable, accounts payable, unearned revenue, accrued liabilities such as taxes payable, salaries and wages payable, and interest payable. There could be so many payables, utilities payable, so you name it. Okay, a lot of them you actually already know. Pretty much all of this video one you already know. So think of it as a review. Let's take a look at notes payable. It must be written promissory note, frequently used to meet short-term financial needs, requires borrower to pay interest, and can be issued for varying periods. Okay, here's an example. First National Bank agrees to lend $100,000 on September 1st. If Cole Williams signs this note, it's 12% 4-month note maturing on January 1st, right? And remember that 12% is your annual interest. When the company issued an interest-bearing note, the amount of assets it receives upon issuance generally equals the face value or the principal. Okay? So interest-bearing, we do have what's called deep discount notes that are issued with zero interest-bearing, but then the borrower will not get the face value. The amount will be significantly lower. So for example, I signed the note for $100,000, but I only received $80,000 in cash. So my $20,000 is actually a built-in interest. So there's no free money out there one way or another. In this case, what will we do? Cole will debit cash for $100,000 and then credit note payable, and that's it. No journal entry for the interest. He doesn't owe any interest yet. Now, if Cole prepares financial statement annually, then he will have to recognize interest expense and interest payable. And of course, this formula looks kind of crazy just because when I bring it in, I don't know why all these go nuts. Maybe I'll figure out how to fix it somehow. So what shall we do? Maybe I'll fix it at least in writing. If you remember the formula, it should be principal of face value, 100,000, times percentage, in our case it's 12%, and then times time. And in this case, we will have how many? It was signed on September 1st, so it will be September, October, November, December, 4 months. So it will be 4 out of 12 months that you will be signing the note, not signing, that will be multiplying it by. And basically you're accruing all the interest. And journal entry will be debit interest expense and credit interest payable to accrue interest for 4 months. The very next day, actually at maturity on January 1st, we will have to pay the interest. That's why we debit note payable to get rid of the liability, and we will get rid of the current liability interest payable that we accrued last night. And then cash paid will be $104,000 in this case. Okay. What else is out there? Recall in the earlier chapter 3, we learned about unearned revenue. So unearned revenue is revenue that is received before the company delivers goods or provided services. And it's actually not even the revenue, it's cash that is received before we deliver goods or provided services. For example, airline tickets, right? You will have unearned ticket revenue, and then ticket revenue that is earned, magazine publishing, hotels, etc., or even colleges, just like we spoke in chapter 3. Let's take a look at this one. Superior University sells 10,000 season football tickets, $50 each, for a 5-game home schedule. So in this case, cash received will be $500,000, and then we'll have to credit a liability on earned ticket revenue for $500,000. And then as we complete each game, because there were 5 games, 1/5 could be recognized as the revenue. So we're going to debit or reduce unearned ticket revenue and then credit ticket revenue to recognize the true revenue that we now earn. Okay, next one, current maturities of long-term debt. Again, you've seen it already earlier. It's a portion of long-term debt that has come due in the upcoming year. There's no adjusting journal entry for that. It just needs to be, it's a classification issue. So in your ledger, you'll still have the full amount as a liability. For example, in this case, it's $25,000. But when we prepare financial statements, meaning the balance sheet, we will reclassify and put $5,000 that needs to be paid within the upcoming year. And then the rest of it, no, $20,000 will be reported as long-term. So we borrowed again in 2019. Financial statements are 2019, and we look how much will be paid within the next year. So January 1st, 2020, there will be one payment of $5,000. That's why it's considered to be current. Again, current maturities of long-term debt, and the rest will be long-term.